Thank you, Paul, for the kind introduction, and thank you to Provoke for inviting us to host this panel discussion. I know many of you were expecting to see my partner, Michael Lasky, up here delivering an overview of the results of this year's survey, but Michael generously ceded the honor to me this year, and instead he'll be taking on my role of official photographer. So thank you, Michael. Before we begin, on behalf of us at D&G, we'd like to express our gratitude to everyone in the room here and those of you who are joining us remotely who participated in our survey. We started this survey 10 years ago, and it's not only expanded in scope over the years, but the growth that we've seen in the sheer number of respondents and the overall enthusiasm it's generated has been really remarkable. The quality and comprehensiveness of our findings is a testament to all of you who complete the survey year after year. So thank you. This year, we've had a tremendous level of participation, as Paul mentioned, 133 respondents. It's more than any prior year. Approximately 75% of our respondents were located in the US, and the remaining 25% spread out all over the globe. 69% of our respondents reported revenue in excess of $5 million a year, and nearly half respondents identified their agencies as being integrated full-service agencies. The results of our survey highlight three distinct trends this year, which are discussed in more detail in our report, which you all have, as well as will be touched upon in our panel. The first is a remarkable and sustained increase both in revenue and profitability over the 3-year period from 2020 to 2022. Agencies also adapting to retain talent and continuing to cut their operating costs in other areas, and a distinct increase in M&A and other strategic transaction activity. So first, let's briefly touch on some of the core numbers. 81% of our respondents indicated they've experienced an increase in revenue over the first 8 months of 2022 as compared to the same period last year, and that's roughly the same percentage as last year. 61% of respondents increased profits for the first 8 months of 2022 compared to the same period last year. Now, this percentage is down slightly from last year's percentage of 72%. Though, while this metric is down, notably the number of respondents who also experienced a decrease in profits has also declined from last year, and the number of respondents experiencing no change in profitability has increased. So that suggests to us somewhat of a slowing on increased profitability this year compared to last year, attributable, we believe, in part to an increase in operating costs, with compensation expense being perhaps one of the biggest culprits. And in general, mid-sized firms reported the highest percentages of experienced revenue growth and tended to have a more difficult time achieving increased profits compared to their smaller or larger counterparts. But to put this all into perspective, as you'll probably recall from our 21 survey results, 21 was by and large a banner year for the industry in terms of revenue generation and profitability. And the results of this year's report indicate yet another exceptional year of performance, a trend we hope to see continuing for the rest of the year and into 23. When we look across agency specialty areas, 3 categories really popped out: agencies with corporate and financial services, tech, and agencies that were just integrated and full service. And as an aside, we did expect to see healthcare as a specialty appear on this list, but it's notably absent. We suspect that this is partially due to many respondents with active healthcare practices placing themselves or viewing themselves as sort of integrated full-service agencies. And these firms with these specialty practices also tended to be the most in-demand acquisition targets of 2022. Similar to many other industries, and in actually some ways outperforming other industries, PRs really embraced the idea of redefining workplaces as part of the post-pandemic new normal. Over 25% of our respondents reported eliminating more than half their office space in 2022, and 10% decided to discontinue or pause expanding into new offices and new locations. And the overwhelming majority of our respondents, over 80%, indicated that they had created flexible working arrangements for their staff. This reorientation from working in the office to working remotely has not resulted in decreased worker productivity. On the contrary, we've seen a compelling correlation between firms with increased financial performance and those that have really leaned into redefined working arrangements. One challenge nearly all firms faced in 2022 has been the hiring and retention of the right talent, especially following furloughs during the pandemic, the great resignation that folks have spoken about today that started in 21, and most recently rising costs of living. Many of our respondents highlighted various creative and financial incentive plans to retain staff in the short run, be that one-time salary corrections, adjustments, expanded health and welfare benefits, retention, inflation bonuses, and as I mentioned, flexible working arrangements. We noticed another key trend among all of our respondents. Those firms that have implemented well-designed long-term incentive plans lead the field in terms of reported revenue and profit percentage increases in this year's survey. These plans, when properly structured, serve as powerful retention tools for senior and second-tier management and help align interests generally across firms. As you can see from the numbers and the percentages reflected on the screen behind me, economics drive behavior, and behavior drives firm profitability. Another common thread linking many of our respondents in this year's survey is a continued commitment to an implementation of diversity, equity, and inclusion policies and initiatives. 60% of firms set up a DEI committee to help define their policies and goals and monitor firm progress. Similarly, 60% reported an overall increase in the number of employees who are Black, Indigenous, people of color in 2022. And more than half, in addition, nearly half of our respondents also conducted a pay equity audit in the last 12 months to evaluate equitable pay practices by gender, race, and other criteria. The results of our 21 survey showed significant growth in these categories from 2020. And the fact that we're seeing these percentages continue to grow in 2022 off the higher levels already set in 21 show a sustained commitment to DE&I progress. Before we move into our panel discussion, I'll wrap up on the final trend coming out of this year's report, a robust M&A picture across the PR industry. There were 59 transactions reported by our respondents so far this year. That's 40% more than the equivalent 9-month period last year. Notably, there were 49 different buyers involved in those 59 transactions, showing just how competitive and diversified the buying landscape has become. And when we look at the profiles of the buyers involved in these transactions, we see the overwhelming majority are either independent agencies or private equity-backed buyers, indicating a broader theme of consolidation throughout the industry, and also a more focused strategy by independent mid-size agencies to continue to acquire to fuel their growth. Private equity has grabbed a significantly larger piece of the public relations M&A pie this year, and as you can see, more than doubling the number of transactions in which PE-backed buyers were involved. We've seen a robust 2 years of M&A activity, but of course we're also seeing now significant headwinds at play. Rising interest rates, continued geopolitical instability, supply chain disruptions that are lingering, rising energy costs, the list goes on. So the question posed to the panel overall is what's next for M&A in the PR industry? And with that, I will turn it over to my partner, Brad Schwartzberg, to continue the discussion with our distinguished panelists.
A lot of numbers there, so we're not going to quiz you on that. You have your survey. So just quickly, so I'm Brad Schwartzberg. I've spoken here before. For those that you don't know me, I'm co-chair of the corporate group at Davis & Gilbert. Davis & Gilbert's a well-established, almost 120-year-old law firm that really specializes in the marketing communication space. I know Paul doesn't like that word, but it is diversified marketing communications. We do a great deal of work in public relations. And so I'm super excited to be here. It's been a 3-year hiatus. It's nice to see a lot of familiar faces and new faces in the audience. I'm very excited about the world of M&A on both, if you're looking to sell or if you're looking to maybe buy before you sell. There's been we've gone through a a period where there was literally nothing to do. When COVID first hit, I garden as a passion, so I spent 3 months. I mean, I said to my partner and co-chair, I'm like, my garden never looked as good as it did in 2020. But then, really in a blink of an eye, I mean, it just pivoted, and M&A was crazy. So I feel very lucky to be joined by 4 distinguished panelists. And before we launch into some of the questions that I have for them, I'm going to allow them to tell you just a little bit about each of them. So Megan, why don't we start with you?
Yeah, hey guys, I'm Megan Wallach. I'm a vice president at Shamrock. I've been there for a little over 8 years. So Shamrock is a sector-focused investment firm based in Los Angeles with a unique history. We were actually founded as a Roy Disney family office 40 years ago. So we've grown up investing in media, entertainment, communications, and related sectors. Advertising, communications, marketing has actually been a big pillar for us. We're very active long-term investors in the space, and so portfolio companies, both past and present, include Wpromote, Baird, Giant, Excel, Adweek, VidMob, et cetera. The list goes on. We actually most recently invested in a company called Highwire. They're a strategic communications and digital marketing firm focused on tech and healthcare clients. We're really excited. They just joined in September, and so very relevant to today's conversation. In terms of kind of our investment approach, we're very partner and growth oriented. We love to find great teams in sectors that we know really well and are excited about. We're thematic in our approach. We love to identify big trends in our spaces and find teams that are backing those trends. And I'd say we're actually very proud. We were just on the Inc.'s 2022 Top 50 Private Equity Firm for founder-led businesses. I think just given our partnership approach to our investing. And lastly, we're very value-oriented. I think we have a commitment to honesty, integrity, and DEI, and that's something when we're looking for firms to partner with, it's important to us.
Thanks. Mauricio?
Hi, nice to meet you. Thank you all. Maurizio Maione. I feel I need you a disclaimer, so spoiler alert, I'm the MOOC speaker. You should have been deserved the CEO I'm serving as chief of staff, Fiorenzo Tagliabue, who was actually in meetings to sell another deal, so it's something to he could not manage. From me behind, I'll be just peeping on 10 years, 9 years of building up an agency, a group that was based in Italy, and is quite, I think, the only one in the PR rankings at certain level. And we started in 2013 with 12 million euro, no, dollar, sorry, of revenue, 100 people, and now we have arrived with over 1,181 million dollars revenue projected for this year. So in a small relative amount of years, we've seen lots of things. We made some deals, 17 around the road, and most of all, we made an experience as a listed company, and then we have a partnership with a private equity fund. So we've seen lots of things in a very short period of time, and I will try to revert to you this experience that I mean. You would have been reserved the original ones. You're getting the copy, a fat copy, but I hope that will be nice enough. Thank you for being here.
Jen?
Hi, I'm Jennifer Gottlieb. I'm the Global President and Chief Client Officer at Real Chemistry. I see a lot of familiar faces in the room today, and like Brad, I'm so happy to be back here after 3 years. I have been at our firm for almost since the beginning, for 17 years. We've been in operation about 20. My business partner, who is our founder and is our chairman today, Jim Weiss, was supposed to be here also. But we can kind of like sub for each other, and he's also busy doing business, to your point. I also have the great opportunity to have been on the seller and buyer side of this equation. We've worked in two partnerships, 2 rounds of private equity, one in 2016 with Mountain Gate Capital, and then in 2019 with New Mountain Capital. We seem to only do partnership with people with the word mountain in their name. And we've actually acquired 13 companies over the course of that time period. So have a lot to offer today from both sides of that perspective.
Great. Nick?
Hi everyone, my name is Nick Burton. I lead global group strategy and M&A for an Australian listed marketing services business called Enero Group. Probably know, or very few of you would have heard of Enero. Maybe the more familiar name is one of our portfolio businesses, Hotwire. But we are, as I said, we're a publicly listed company, really focused on building out kind of both integrated marcoms across all the spectrums of services, businesses, but focused on a few select industries. So technology being one, healthcare being another, and then probably even sequentially thinking about it that way, we will also start to build out a kind of growth consumer business focused on sort of high growth startup style clients. So that's who we are. I bring the sort of the public company point of view here. I was a management consultant before this for my sins, so I'm coming up to speed on the lingo and terminology of the industry, hopefully fairly quickly.
Great, thanks, Nick. So I think our goal here over the balance of the session is with understanding that this is the Entrepreneurs Forum, and most of the people in the audience and then watching virtually are independent firms, and you want to run your independent firm and obviously produce the best work product on behalf of your clients. But I'm a big believer that particularly for the independent owners out there, very often your agency, your firm represents a significant portion of your own personal net worth and your own personal assets. And I've said this before, but it's kind of like your teeth. If you ignore it, it'll go away. So I think what you need to do is manage your company and to have an idea as to what is it really worth, besides just doing fantastic work and delivering great service and product to your clients. Take a step out for a second and have a look at it as if somebody else would view it. And I'm also a believer that a good indication of trying to understand what the future holds is to study a little bit of the history as to what's transpired. So like I said in the beginning of the talk, we're coming off of sort of unprecedented times. I've been practicing law for longer than I'd like to admit, but probably close to 35 years. And that period of 18 months was just extraordinary in its volume. Across a lot of sectors, but public relations and communication sector was just tremendous. So I'm going to start my first question with Megan. And so can you give us an idea of why was it so robust over the past 18 months?
Yeah, and I'll preface, I'm not going to talk about the last maybe 8 weeks or so. I'm going to talk about the prior 18 months, because I think a few things have changed. But I think it's important to talk about the macro environment. So there's been inexpensive borrowing, strong equity markets leading to a lot of M&A firepower for strategics. There's been a lot of dry powder and fierce competition among the investment firms. There's also been opportunistic selling, just given the multiples in the hot market. I think lastly, the world's becoming more complex, so people are thinking about capabilities and scale as being very value creative. So when you think about marketing communications then, I think there's been a lot of big shifts in the industry and a lot of opportunity. And so when you think about that, there's been a growing importance of strategic communications, the convergence of marketing and communications. And I think the way that consumers are interacting and expecting companies to behave is a little bit different. They're looking for a lot more purpose, a lot more authenticity. And so companies are having to think about being brands themselves. This communication is always never turned off. It's an always on strategy. You have to think about your messaging across different channels, different stakeholders. And so it's a real C-suite issue now. It's not just isolated to the communications team. And as a result, I think communication budgets are tapping into the larger marketing dollars and are only increasing. And I think COVID accelerated that. Companies had to rethink the way that they built relationships with consumers and stakeholders and their employees. And so I think the traditional way of PR has completely changed. There's been big and interesting shifts in the industry. And with that comes opportunity. For best-in-class companies, there's been historically a fragmented market to kind of come together and build this new modern age communications firm. And I think the other thing that's been happening too is that clients are wanting more integrated services for you to offer more. And so there's been a big value creation in terms of tucking in more acquisitions and bringing in more capabilities. So I think with that growth, with that kind of need to be that integrated service offering, you've seen a lot of M&A in this sector.
Excellent. Jen, do you offer a perspective from Real Chemistry and why you might think it's
Sure. So we are healthcare focused. I should have mentioned that in my introduction for those of you who don't know us very well. We're all healthcare, and for us, since the pandemic, healthcare has just been, evolving 10 times faster from a digital and analytics and AI standpoint than we've ever seen before. And I think those of us who have spent our whole career in healthcare have been waiting for that moment. So, one silver lining of obviously a very tragic pandemic was the recognition that there was so much opportunity to really make productive change in healthcare. And we saw, finally like the coming of age of telehealth and, of real digitization of health services, as well as health products and pharma and every part of the industry, not to mention the R&D piece, of the vaccine and whatnot. So healthcare, I always say, in many ways, it's one of the industries that's, speaking of the last 8 weeks, it's, not as impacted, I don't want to jinx myself, on the macroeconomic trends, having been through, a couple of recessions with this industry. But I would say that the healthcare industry in particular, related to M&A and related to private equity in particular, which is my experience, has, never been as robust as it is today. We acquired 9 companies during the pandemic, to give you context.
Yeah. And I think what's interesting too is that in the, you have this sort of big umbrella of marketing communications, and there's a lot of dollars that are spent there. And maybe the spend year over year is not necessarily going up kind of globally, but there's this pendulum that's constantly swinging underneath it. And to use the word digital, because now digital is basically the same as just marketing, but to that swinging of the pendulum and grabbing dollars in a heavily growth-oriented sector is a lot of what's fueling too, I think, the M&A, and particularly, all acquirers, strategic and PE, are always looking to capitalize on that. So Nick, I guess, with the headwinds that Mark mentioned, we've got an increase, interest rate environment, we've got geopolitical concerns. I mean, what do you think the future holds?
I don't think we're necessarily going to see a dramatic pullback in the market where all of a sudden the kind of deals die up. I think fundamentally our industry has changed. I was saying to Brad from day one earlier, where we had a kind of handful of big publicly listed acquirers doing almost all the deals. We're talking sort of 10 years ago, even 5 years ago. Now on the buy side, you've got you've still got those big behemoths, but you've got private equity, you've got private equity-backed businesses doing kind of roll-up plays, you've got mid-sized kind of independent or kind of pseudo-independent businesses like our own. You've got the tech firms, Deloitte, Accenture. This buyer universe has just gone like this, and that hasn't changed in the last 8 weeks. All those buyers are still out there looking for the kind of next kind of service offering and capability to add to their business. And then I think, to Megan's point at the beginning, what constitutes a kind of a Marcom's asset or Marcom's target has also expanded. Where it would have been kind of historically an advertising agency, a PR agency, a digital agency. Now you've got businesses. I mean, we are at the moment in discussions with a CRM integrator. Who in the marketing industry 10 years ago was talking to a CRM integration business, and it's a bit of that kind of point around the lines of decision making for acquisition is really blurring, where it used to be the CMO or the Chief Communications Officer. Now it's the CTO or CIO, the CEO. They're all kind of taking part in these decisions around, what the future strategy of a kind of Marcom's business and our clients, what that strategy looks like. And so the budgets continue to expand. Now, I don't think we're going to see a 2021 level kind of deal frenzy. There is a reality of the kind of macro environment. So I think there'll be certain hurdles that are higher now than they were a year ago around growth, around profitability. But I don't think that's going to fundamentally kind of destroy the appetite for acquisition that's out there in this kind of expanded marketplace.
Yeah, I think I would agree with that. I think it was too frothy through 21. A lot of buyers, both strategic and PE, were buying at accelerated multiples because the growth was so tremendous. I think now that growth, and Mark indicated in the survey results that the growth was really extraordinary. So it's just simple math, right? I mean, if you're going to pay a 10x multiple, which might be deemed to be high, and it's off of this, but you're expecting the company to grow, and so that next year, the growth is up 60%, well then that 10x multiple is like a 7x or a 6x. So I think when growth expectations scale back, that has a corresponding relation to, the multiples that are going to be paid. But I agree with Nick. I don't think that I don't think it's going to come to a standstill. But Mauricio, why don't you speak a little bit, because you're looking at a lot of targets, right? And so what do you think are some of the biggest challenges that the industry, the M&A industry, is going to face, and particularly as it relates to, PR?
Well, first of all, I agree with what Nick was saying, and far more than this. I know it's not polite to quote another study, but since it's very coherent with your findings, I will dare to do. That is PricewaterhouseCoopers. That is considering a wider spectrum, that is called marketing in general, but so advertising. But he just recorded that in 4 years, so from 2018 to today, the amount of volume of deals managed by private equity has doubled from 25% to 50%. So there is lots of interest there. I understand that we are culminating the curve, so it won't be growing as ever, but I think there will be still interest. And we also record from our perspective the larger quantity of people that want or are interested or are considering selling. I mean, in my previous life, I was bought by WPP, so one of the big buyers. And at that time, our case was we were a 25 years old agency that was seeking for an exit strategy. So that was likely the only one driver for that. And now I see in Italy is not the largest of the market for our industry, but there are on the market agencies that are solid with at least 8 years of history. So there is different visions on how and why you sell. And on the other hand, money is still, it's getting more expensive, but it's still available. So, there is like a supermarket scenario. You get off the shelf whatever you want, and that gives you a very important challenge from a buyer point of view. That is, what's the sense of making another acquisitions that comes to having a clear, significant strategies. So how the next one will match with the strategy and will support. If the strategy is sound, the money will follow. The resources will be provided, and it makes sense for you buyers and possibly for the sellers. So I think the real challenge is understanding, apart from the obvious economics, obviously, whether you are talking with the right agency that match your strategies and can, a partner for the future. That I think is the most difficult challenge to handle these days.
And Megan, you touched on that before, right? On how to deploy that strategy and being a good partner. So do you want to comment on that?
Yeah, I think there's a lot of uncertainty going on right now. I think that's, to me, one of the biggest challenges. It's kind of like, where are we right now? Like, are we in a recession? What are my financials going to be the rest of the year? What does that look like? And so I think going back to that partnership approach, it's kind of making everyone, both buyers and sellers, think about, what do I really want and what do I really need? And that's applying to the M&A process a little bit more thoughtfully. So, I think for us, we're actually seeing a little bit more activity because we offer a partner that to help navigate that uncertainty and that choppiness for sellers, and we kind of have a longer term horizon. But I think buyers are really sitting down, is what you were talking about, is, are they best in class in what they do? Are they is their end market more recession resilient healthcare? And kind of focusing on companies there. You see diligence processes taking a little bit longer because buyers are trying to figure that out. They want to see the financial performance. They want to make sure the strategy is there. And so I think you'll see kind of processes still happen, maybe at a slower rate, but there's going to be a lot more diligence, like, is this the right one for us? And I think that's going to be the shift.
That's interesting. So let's move then to Jen. You also look at a lot of targets on behalf of Real Chemistry. So, what are some really important aspects that you look for when you're identifying a potential target?
Sure. It comes down to three main things. Number one, we are always looking for something that's complementary to what we already have. So we listen to our clients. We listen a lot, and we see what they're asking for, right? So right now in healthcare, a lot of them are looking for help in value and access, that kind of area. So that's an area obviously that we're interested in continuing to look for expertise in. So a lot of it is, how do we bring in something complementary to what we have? It doesn't mean that we don't acquire firms that look somewhat like something we do have, but it has to bring either more firepower, a complementary client list. There are exceptions to that rule. The second piece is something what Megan said, best in class. So we do a lot of diligence and get real with anybody that we're meeting with in the process to really just kick the tires on, are what we hearing exactly what's happening on the inside? We look to make sure there's just enough diversification of clientele, not like client concentration. You do see that a lot. Sometimes the rationale for that, but you need a bit of confidence that that's not going to happen. So the diversification, both in terms of service areas as well as in a nice client mix and client spread, is very important. And I think the third one is the talent and the bench of people often underneath the top people. So we actually, we do look for a lot of businesses where the founders stay. A lot of the founders stay with us over time, and we really like that. But it is really important that there's no like key man or key woman syndrome going on. And so it's most important to see that there's a bench of really like solid people that have a lot of their relationships with their clients tied to them, and there's not a key man or key woman situation.
Yeah, definitely helpful. So, and mostly, right, you're looking, because you're owned now by, and have been owned by, a private equity shop, so it's a lot of it's tuck under, and we'll talk about deal structuring, because I think it's important for the audience to understand the different opportunities that are out there. Nick brings the public company perspective to it. So what do you look for? Because are you looking more to add on to within an industry sector, a specialty? I mean, probably now geographic location becomes less relevant in a remote environment. So what are some of the key points that you look for?
I mean, there's sort of what is specific to Anero's growth strategy. And so we have an M&A strategy agreed with our board, and we've kind of communicated to our investors around where the direction is for Anero, and I kind of touched on them earlier before around tech, healthcare, and kind of growth consumer. And then within that, really the strategy is to build as modern a kind of set of capabilities as we possibly can. That is a fairly loose kind of definition of what we're looking for, but kind of on purpose, because we need to be agile and respond to the targets that are the kind of companies, the partners that are out there, the evolving need of clients and the kind of environment. But probably what I would talk about more broadly, I guess, a universal truth for us is we are a growth business. And so that is our raison d'etre at the moment. Our investors are all expecting growth. And so when I go to kind of meet with a business and think about, are they a potential partner for us? I'm not looking at them to think, okay, what cost can we remove from this business and create synergy that way? I'm looking at them for how can we massively accelerate their growth? What can they do for us? And how is that, it's a bit of a boring old thing to say, but 1 + 1 = 3. That's really key for us. And then I think finally, we've learned pretty quickly over time, the cultural fit is so important. You're going to be going to work every day with these people and building this vision together. So for us, in terms of what we're looking for, it's people with a similar set of ambition or similar kind of matched ambition to us. We don't have an Anero culture. We don't prescribe that they need to run their businesses in a certain way. But it is, I think, like was mentioned in the trust discussion, shared values, shared ambition, and a clear evidence that there is investment in people and investment in culture. Because if they're missing that, they're not the right fit for us. I think there are plenty of war stories going around the industry of kind of cultural mismatches, particularly from the big holdcos and when they've bought businesses. And for us, that would be an absolute disaster. So we're pretty clear that is a critical part of our kind of evaluation process.
I see a lot of head shaking from my panelists. Anybody want to add on to that?
I can add something to that, even though I went already. So you sparked a few things. I think that, we often, when I look back at the 13 acquisitions over the years, more often than not, there were these moments of like who bought who in a good way, because the acquired companies actually took the reins and took the lead in certain areas of our business. And I feel like we really put our money where our mouth is, in that it's not like come here and just become part of our culture. We want your culture and your expertise to come in and lead us. And I feel like we've replicated that over and over again, and we've always been better for it. So I think that's a really important point.
Yeah, I started, when I first started doing M&A, when I joined Davis & Gilbert 29 years ago. I did a lot of acquisitions for Omnicom, and the chief financial officer, who you wouldn't think is a touchy-feely person, but he really was, Fred Meyer, may he rest in peace. I learned a great deal from him. He did a lot of lecturing at these conferences, and he always led off by saying, the single most important thing, we talk about the economics, this is it's fit, fit, fit. And I think that's probably a resonating theme. So I think what I'd like to move into, though, because it's important, I believe, for a lot of the firms that are out there that are trying to learn. Again, we at D&G do a lot of M&A. We do a lot of M&A on the buy side. We do a lot of M&A on the sell side. And a big part of my practice is prepping potential sellers for an exit strategy. And even if that exit strategy might be 3 years down the line, 5 years down the line, 7 years down the line, because I think if you can step outside your company and analyze it a little bit as a buyer might actually acquire you, even if you choose never ever to sell, it'll actually make you a more profitable and well-informed agency. So I'm going to ask Mauricio, you in first instance. I mean, again, when you're diligencing targets, you're meeting with targets. I mean, is there some advice that you can offer generally to potential sellers of their agencies, things they might consider doing now?
Oh, yes. Maybe the answer to these questions reflects our approach. That is, generally speaking, we do not acquire the 100% of the shares, so we want to keep the founders, the owners, involved in the business. That is, adamant for us, because we haven't got the financial shoulder that are required to buy 100%, and of course, at the end of the day, this is a business of people, so you have to secure the people. So maybe that's the first thing just to say. Secondly, from my experience, you're never ready for an acquisition. I mean, although you are profitable, you've been doing your homework very well. At the time of the due diligence, always, oh gosh, I could have been done better. But apart from this, I think you all have to have all the economics under control. That is obvious. What we really appreciate in that is the fact that you are, again, as Nick said, or in a previous session was said, you are trustworthy. So you understand our vision and you beat on that. You are available to make a part of the road with us, and that is important. So being transparent, because at the end of the day, the due diligence won't fail. I mean, there's plenty of good people doing whatever kind of due diligence is needed, and so we are. When we sit there at the due diligence level, we know already that the deal is done and what will be looking like at the end. But to go there, you have to be, able to deliver the trust. And in addition, maybe 2 triggers, minor ones, but as I think also Jennifer and Nick told already, what is really important, at least from our perspective, that is very focused on corporate. So we do certain specific things, not all. It's how you demonstrate you grow your talent. So the wider the talent panel is, for us is better. And secondly, what kind of specialty do you bring? What cherries you can add on our cake, we can add on top of our cakes that are very important, in making us understanding that's the perfect match. That's how it works. So apart from the figures that some CFO will make up for you, and they will work, definitely, or hopefully they will work. That's how you are able to invest on your future together with the buyers, and how you treat your people, how you grow your people, and what kind of specimen do you have. That are at the end of the day, the decision makers, right, from our perspective.
And Megan, I guess, Shamrock, of course, you look at a lot of companies. The objective is to, I guess, initially acquire that platform company and then bring in add-ons underneath. So what's important for you? Like, what do you think sellers should be doing potentially in advance of a Shamrock look under the hood?
Yeah, it's probably similar, but it's, I think being prepared is important. And so it's not just about, hey, I'm about to go sell, let's prepare now. We actually find the best prepared companies are ones that have been thinking about being sellable from day one, whether you're ever going to go in a process or not. But it is about the financial hygiene, making sure that you have easy data, it's understandable. But I also think it's about thinking about how does an outsider, how would they view my business, and kind of telling that to your team and thinking about that, where it's like my strategy, my vision, is that resonating with my employees? Is that resonating with my customers in the industry? And I think I'm now going to be the fourth person to mention this, but team and culture are so important. I would say invest in your team early on, even if you don't go to market. It'll just pay dividends to your business and grow exponentially. I just think talent is so important. So that would be one where I would echo the rest of the group. And then finally, when you're thinking about going to market, educate yourself. There's going to be so many different options, and they're all slightly different. And so, as buyers, we do this all the time, but at least you could start to understand what the different options are. And then if you have a leadership team or whoever's helping make that decision, talk about it beforehand and be on the same page when you go to market, because I think it's really important for team alignment.
Yeah. So I want to continue to carry on. So, Nick, when you find a target that you're interested in, you're going to exchange, an NDA or confidentiality agreement, and you're going to start to conduct your due diligence, right? And that's something I think for, again, the independents out there to understand, that when you're going to actually enter that phase of the process of potentially selling your company, you're going to undress, and they're going to, buyer's going to look at every aspect of your company. So you'd like to identify any hidden issues as early as possible. But maybe you could share, some war stories or some issues that you've seen that maybe in best case have resulted in purchase price erosion, and maybe in worst case have derailed the deal.
I suppose they're probably, this could be a really long list. Right? There are so many things that could derail a deal. It gets high pressure, people get stressed. It's not just a kind of financial, legal negotiation. You're dealing with people on the other side of the table, and people forget about that. You might just decide you hate the person on the other side of the table, and that's enough. But for me, there's probably three types of things that generally go wrong in a DD process. One is you find skeletons in the closet, and that could be legal issues, it could be employee issues, it could be financial issues. We came across a company that had been doing their revenue attribution completely incorrectly, despite saying that they did. And that wasn't a deal killer, but it took a long time for us to get back into the right place of kind of trusting them and their financial processes and rigor. I think the second is, and it's been spoken about a bit, is kind of alignment and agreeance with the strategic vision, from the very beginning, right? We try to, as best as we can, be very open and honest around where we see the direction of travel together and what we think we can bring to each other. And we've had a deal almost fall over again, but didn't, when the business we were looking to acquire decided all of a sudden halfway through due diligence that actually they wanted to keep their brand name, and they wanted to kind of not be folded into one of our other businesses. And really they had a different view of kind of their role and their not importance, but their contribution to the group. And so, we navigated around that because we believed in the team and what they could bring, but it wasn't, certainly wasn't smooth sailing. We had to go back to our board and kind of discuss that, this new strategic pathway. And so that was a potential one that could have killed a deal. And then again, we're sounding like broken records here, but for me, the cultural fit is the big one. That's where we've had deals get killed. So, I'd say my main bit of advice here is just be on your best behavior when you're meeting with people. I've been in a Zoom era. It's quite easy to be a bit removed, and you might not be wearing any pants, but you look kind of good on the screen. But we try to make sure that we always meet with people in person. And so one of my bits of advice here would be, don't go telling me over dinner after a few drinks that you're HR's worst nightmare, for example, and make passing remarks at the waitress. It seems very obvious, but it's sort of interesting what happens when you have dinner and a few drinks with people, how their behaviours can kind of come out. So, treat this as one of the most important decisions you'll make, as Brad said, with your kind of own personal net wealth. Protect it, make sure you do present yourself in the best possible way.
Shall I add on this one point about how to prepare for? And from our experience, the best prepared company for selling was GSG, the last one deal, until the next one.
We represent
and they
the
were
seller.
not, and they were not considering of selling. And this revert, I mean, the effort on the buyer. So we have to convince them of the good idea of selling. So you have to get prepared. Obviously, you have to be sound, fit, credible. But on the other hand, pretend very much from the buyers to tell what is in his mind or in their mind, because at the end of the day, that will make all the difference.
So I'm just going to offer a few specifics actually that I really think you should think about. When I prep companies for sale, I break it into two categories. I break it into the individual preparation, because most of the firms that are being acquired are owned by two-legged individuals, and then the corporate preparation, the preparation for your company. The first is on the individual side. And the first thing you have to decide is, do I want to sell? Because there's a lot of sellers that like the number but don't like the idea of giving up their company. And you're either selling or you're not selling. So if you're going to sell, you're selling, and you need to be ready for that. Also on the individual side, it is money, right? So part of the analysis that you want to do early on before you're going to put your toe in the water is to figure out, what's the number? Like, what am I going to be interested in selling my company for? How much is enough? How much at closing? Maybe some of the consideration is going to come further down the road. What do I need from my own personal perspective to receive on an after-tax basis at closing to be happy? And do I own the company all by myself? Maybe I have a partner or two partners, and maybe you have different objectives. Maybe one's approaching retirement, one's just getting going. So to have all of those individual conversations in private, and to have your ducks in a row before you're going to air all of that with a potential buyer is important to do. On the corporate side, like everyone said, I think a good solid set of financials, okay? Depending upon your size, a lot of buyers, when they come in and diligence you, they want to analyze your numbers, right? Your balance sheet, your profit and loss statement, and generally they're going to like those to be prepared either in accordance with generally accepted accounting principles in the US or IFRS internationally. And you may make a decision to do that or not to do it, but you should be aware that in all likelihood, in the context of an acquisition, that's going to be required of you. So there's financial preparation. There's your internal house preparation, your contracts, how you're contracting with your clients. Are you market? Are there things out there that are rogue that maybe doesn't affect you right now while you're independent? But if you're going to be acquired by a larger organization, perhaps it does. And then to deal with the synergy and culture and fit, I'm a believer in getting everybody to row in the same direction. So, to use Mark's line on economics drive behavior, I mean, if you can put in place well-designed compensation plans so that it's win-win, not just for the 1, 2, or 3 owners on the sale of the company, but for everybody. When a buyer comes in and looks at a well-diligenced and a well-prepared company, they're going to be like, wow, this is, they really were thoughtful. They really, not only is it a good culture and people like each other, but the leaders have really put their money where their mouths are and have really done a good job. So I want to leave some time for Q&A. So just what I think would be helpful for everyone is to hear just a quick perspective as to, let's start with Shamrock, right? When you guys buy, just talk a little bit about your structure.
Yeah, I think, that's a good question. So, and for Shamrock or any financial buyer, there is going to be an exit period, right? It's not prescribed time, but at some point we do have to exit because we return money to our LPs. And so typically that can be from 2 to 8 years. We say 3 to 5 years is kind of that scenario. It really depends on where we're performing and what's going on. So we're always kind of thinking about ultimately what's that exit. So there is a little bit of a math game going on, right? You have to think about, as you start to evaluate some of the criteria that the panel has been talking about in terms of leadership in the space, differentiation among peers, the buyer or the clients, the relationship with those clients, then it really dives into, okay, what's their growth? Where is that growth going? What's the margin? Is there opportunity to grow that margin? And what's the scale of business? Are you aligned in your values? And you're kind of thinking about, hey, what value can we create over the next 5 years together? I'm using 5 years again as just an example. And that kind of then you kind of check that against, comps. What's transaction comps? What are trading? How does this what's the macro environment in the industry? And that's how we kind of come up with a multiple per se. A lot of the deals that we do, we actually love the deals where we buy anywhere between 51% and 80% of the business, because as you were saying, we love founders still kind of being a part of the business. We love to partner with founders. And so that's typically how we think about enterprise value and structure, is that we love to have people along ride with us.
And just to elaborate on that, and you if I'm over my skis, Megan, you'll tell me, but when PE buys, it's a little, because what private equity does is, yes, there's a retention. They're going to come in and buy 51 to 80%, but there's a difference between the retaining equity in your company and the private equity creating this platform company that now they're going to buy a bunch. So you're going to own your equity in the mothership. You're no longer going to own the equity in your own company. And you have to, different than, let's say, a publicly traded company, that their acquisition philosophy is to buy, to build, and to hold, right? Because they want to be accretive to their share price. Private equity is different. Private equity is to buy, to build, and then to sell again. So it's a second bite at the apple. So it's two very different opportunities. Both can be absolutely equally as beneficial to a target, and this is just sort of the optionality. So
Yeah, I'd say like what we like to say about private equity, and we can talk about the opportunities that come with it, is it's unique where you get to take money off the table today and de-risk a little bit, but that you still got to remain independent. You still have, in some cases, control. And there's that big second bite of the apple, which is Shamrock. We hopefully is always a big juicy bite. But we say, what we like to say is, hey, you're taking a bet on yourself, right? You're bringing in that strategic capital. You're bringing in a strategic partner to execute on a plan that your team's come up with, that you have the same team and culture, and it's just really growing the opportunities there. So it's really about, hey, what can we do together and create that value over time?
Yeah. And Jen, maybe you can touch on it too, because like you've experienced it, right, from a private equity perspective. So
Absolutely. And we've had two great experiences with private equity. I tell people that all the time when they ask me about it. To what Megan said, it's like you get to keep a lot of your independence. You get, an infusion of investment. You get great counsel. When we looked for our private equity partners, I mean, our first one, we actually were not in a process. They came and found us, and the second one we were in a process. But in both times, we were really looking for cultural fit with a private equity partner. Like, we didn't want somebody to just write a check. We wanted somebody who was going to give us business counsel. We were hungry for help in terms of scaling and in terms of that expertise, and we've found that in private equity, and that's been amazing. And the other thing is, to Megan's point again, like it's, we were the platform in both. So, it's a buy and build strategy, and, just very, very important, to be working in partnership, with the partner, with the sponsor, and kind of know where you're going, right? Like, I think we did a planning process with Mountain Gate early on that we, at our closing dinner, we held up a kind of the slide on it, and we said we actually did everything we said we were going to do, and there was such pride, both from the sponsor as well as us.
Yeah. And so there's difference again, and I think they're both equally attractive. So Nick, why don't you talk about why it's beneficial to be acquired more by a strategic as opposed to a PE?
I think one of the big differences is clearly the kind of the added value that you can get from a strategic. In reality, I don't think there's all of that much difference, particularly for Enero. We aren't a huge holding company. You're not getting swallowed up by this kind of massive conglomerate of 500 different businesses. And so for us, when we look to acquire businesses, it is with the intention that they retain their independence, they build their business, they grow it together, but that we can add fuel to that fire through various different ways. It might be sharing of clients, it might be sharing of capabilities, it might be funding from Enero to help them execute kind of their vision. So in many respects, it's quite similar to what you'd expect with private equity investment. We don't have that second bite at the apple necessarily. For Enero specifically, our deal structures are typically a mix of cash up front, Enero stock up front. That's one of the benefits of being a publicly listed business. And then we do usually structure some sort of earnout. And people kind of hear earnouts, and again, they think, oh, WPP, they're trying to halve my money, that sort of thing. But for us, that is our way of almost, again, enabling a bit of a kind of doubling or acceleration of your potential sale proceeds, because you don't have to take all the risk just on what the business is today. You could get valued on what the business is in 2 or 3 years' time, and get some sort of upside from that as well as the capital appreciation of the share price, which hopefully you'd be kind of personally supporting and helping grow.
Excellent. So we only have about 5 minutes left, so I thought I would throw out some questions. So, Michael? You want to wait for maybe a mic to come through? So either that or stand up, Michael, and really belt it.
When we're dealing with clients, and just like you said before, the biggest question is maybe they do, and not sure of it, but can you talk a little bit what you've seen in the past year in the way of multiples?
I'll throw it to anybody.
Yeah, like I think multiples are dependent on, there's a lot of different factors you look into it. So some is, as we were talking about, like what sector you're in, are you a leadership position, what's the scale, what's the growth potential, for strategic, it's probably even like what value are you adding to the platform. I mean, multiples, right? I think in this market on the high end can go, again, these are like the scaled best-in-class platforms up to the mid-teens. I think they're seeing a lot of best-in-class, pretty scaled assets at more than 10 times multiple. And there's some that are a little bit smaller when you're a smaller asset, but really well, maybe have some customer diversification that you need to do. But so you can kind of see a range just dependent on where your business is in that spectrum.
And also the panelists are here all, we're going to be here for the afternoon, so you can certainly ask some more questions. I think, Paul, we have a question from...
Yeah, I have a question that came in from the people watching at home.
Sure.
And it's from the UK, so congratulations on being up late. And this is sort of for everybody, I guess, but I can't help thinking that it's directed at Nick more than anybody else. And it refers to Anero's experience with Frank PR, which bought themselves back from you guys a few years ago. And it is, what kind of escape hatch do you offer to firms if they realize they made a tragic mistake?
Ouch. Yeah. Yeah. Look, I mean, so I didn't do the kind of Frank MBO or the kind of sell back to the founder, so I can't talk specifically to that. But I think there was a mutual understanding that actually Anero wasn't the right home for them and their team and where they wanted to be. And we've done that a number of times in our past. And so I think having that open discussion around why things aren't working and therefore what the potential options are is part and parcel of an acquisition. I mean, they weren't tied. I mean, in Frank's instance, they still owned part of the business. And so they wanted to kind of keep that value and felt like they could grow it. So I don't have a kind of a perfect answer there. I mean, it's a little bit back to Brad's point. As part of your preparation, be kind of clear on, do you really want to sell? I think you don't want to get in the situation where very soon after you regret everything that happened. I mean, Frank were with the Anero group for a long, long time, and the Anero who bought Frank were very different to the Anero of today. And so, I think they were perfectly right in their desire to go back independent again. But there aren't necessarily you can try and put structures into your deal, into your transactions, but that's a challenging thing. We'd probably say no to that because again, it just shows that there's not a kind of shared vision and a shared commitment to growth.
Yeah, I would say that, to me, I think when you commit to sell, you really want to do all your homework and sell. Listen, not every single M&A deal is going to work out just, swimmingly. Some will not work out. So, but you always maintain integrity. You always maintain and do the best work you possibly can do. And I've been involved in a number of transactions where 2, 3, 4, 5 years, 6 years, 10 years down the line, it made sense for that particular management team to buy themselves back, and it's another deal. And you sort of, structure it. Other questions?
We manage one of these.
Wrap up, I think, Brad.
Oh, okay. All right, so sorry, but we'll be around to answer questions, so.
We will.
Okay.